So what did you think of that poll?
That's what I expected.
You can sit.
Well, it was just so exciting.
Stand up.
I think it's to be expected. I think this is, as you said, the challenge of investing in these times is the data is hard to interpret. And I think depending on your lens, you're gonna interpret it differently.
So you have 30% sees back half of 2023, 30% front half of 2024, 30% back half of 2024. Is that more volatility and more market for Mike?
It clearly is volatility, and I know we'll hopefully talk about the alternative investment front. When I look at that, that calms me, because as an alternative investor with a 5 to 10-year horizon, if we're banding around a 6 to 9 month window where we'll get some stability, that's a great environment for me. So the beauty of what I do is I don't have to get caught up in the day-to-day headlines. So that's actually quite comforting.
You can read that?
Yes.
I'm so impressed.
I got LASIK about 10 years ago. It's still working.
Okay, fair enough. He's looking at the poll on the screen, by the way. So based on that, though, and I appreciate that this might be a 9-month window of, say, volatility, but it could herald a whole different regime, right? Higher rates for longer, terminal rate of 5%, increased volatility, just look at the UK, and that does affect something that you're going to be investing in for 5 to 10 years.
It does. It affects flows. It affects the trajectory of cash flow. But when you put it over a 10-year horizon, and this is something that I keep trying to tell myself and the folks that work at Ares, we enjoyed incredibly high returns on the other side of this. And it's not so long ago that we were in an environment where we were managing 5% rates. So we're all grappling with rate of change and uncertainty, but when we settle in a world where we have a 4.5% to 5% terminal rate and the markets adjust to that, we know how to do that. So the day-to-day volatility, I think, presents opportunity for those that are willing to look through it, those with liquidity and those with a long-term horizon. But the opportunity that we're all looking forward to is something that we've all done before. So from my seat, this feels a lot more like a traditional credit cycle, and I think that's being reflected in the underlying performance of the economy. We're coming off of 2 big crises, one the pandemic, one the GFC, totally different. So I think the psychology is still a little, we've grown to expect that every time that the markets are going through a transition, it has to be chaotic and it has to be a major crisis. That's not the way I'm feeling about this current environment.
And that the Fed's going to eventually step in to solve everything.
I think the Fed is doing exactly what they told us they're going to do, right? So the markets may not like what they're doing in certain cases, or they may wish that they were doing something else, but the key to successful central bank intervention is to actually do what you say you're going to do. So I think the challenge that you have in the UK, for example, is a lack of credibility and a lack of clarity. The Fed is telling us exactly what they're going to do. They're doing it, and the markets are responding.
Mm-hmm. So let's get to all of that. There's so much to unpack. But let's just start with the opportunity in credit, for example. So if you're looking for a default cycle, does this create more or less opportunity for you? How do you make money off of that?
Sure. So in our credit business, the bulk of our credit assets are in the private credit markets. So we are self-originating and controlling assets, portfolio managing them in a way that's slightly different than if you were buying high-yield bonds or leveraged loans. What I can say is if you look at the portfolio performance, the underlying, and we have investments in close to 3,000 middle market companies, the underlying performance is still very strong. So I think what is making this so challenging is the inflation picture is a reflection of a still strong economy. Usually when we're talking about risk of recession and defaults, the economy is already weak. We're projecting weakening, but we're not seeing it yet, and that's actually quite challenging. Particularly because spreads aren't necessarily reflecting the potential distress. So if you look at where default rates are now, they're still near historic lows. If you look at interest coverage rates across the sub-investment grade market, they're still at or near all-time highs. There's a lot of dry powder and liquidity in the market. The markets are functioning well, so we're not seeing a lot of structural imbalances. So it's an interesting time, right? Because you like what you own. Mm-hmm. The value of what you own has obviously come down given the move in rates, but you're not seeing massive credit deterioration the way that you would expect if people were so anxious about it.
Are we gonna?
I think you'll start to see it clearly. That's inevitable. But again, when you look at the market's ability to navigate peak defaults, through the GFC, we got up to 10% type default rates. If you look at historical averages, depending on the market, 3 to 4%, and we're sub 2. So we have a long way to go before we even get to a level of distress in these markets that just puts us on equal footing with where we've been before.
So a good example of how the markets are freezing up is Citrix and Brightspeed. When banks tried to offload those loans, they had a really hard time doing that. Did that process not work the way it should have? Or was there some disorderly stuff coming in?
It worked exactly as it was supposed to work. And I think the banks are clearly digesting a lot right now, combination of CECL, write-downs in their bond portfolio, working their way through AOCI on their balance sheet, stress test constraining capital, and now unsold inventory. But if you juxtapose this to what we experienced in the financial crisis, no systemic risk really there. The markets are orderly, the loans repriced, and the market absorbed them. And candidly, those that were able to buy those assets from the banks at the prices they did, I think are going to be pretty happy with those exposures.
Did you?
We did, yeah.
Are you happy with that exposure?
I am.
So do you think, though, that the valuation hit that we've seen in the bond market and the equity market, public markets, does that eventually come to your world?
Yeah.
And I guess how bad does that look?
Well, so the private credit markets have been evolving over the last 20 to 30 years as the banks have grown, moved to scale, focused on investment-grade borrowers more than sub-investment grade. So we have always lived in this world of symbiosis with the banks. When we get into a market like the one we're in now, and the banks are effectively pulling out of the market, that means the loan market is effectively closed, the high-yield market's effectively closed, the IPO market's effectively closed, the private markets, whether it's private credit or private equity, become a very important liquidity provider into the markets. And we're able to do it with a lot of selectivity and at some pretty attractive risk returns. So, these types of markets tend to be very good investment opportunities for private managers.
And before we get to the opportunities for a second, I just want to get an idea of, do you feel like the banks are pulling back on lending in part because of all the regulations that they might have around it, or that they see something that you don't see?
I actually think that and you'll have to ask bank executives, I think most bank executives would probably tell you what I see, which is credit portfolios are healthy, consumers stronger than you may expect, lots of liquidity in the system, and a desire to lend. I think there's some repression going on right now because they're dealing with losses from having to sell inventory. They're dealing with the implementation of CECL, as I mentioned. They're dealing with bond markdowns, and they're dealing with regulatory capital constraint. But banks are very well capitalized. The markets are functioning well, and their portfolios are strong. So I think if you got them in a moment of honesty, they would tell you that they'd like to be more active, but they can't be.
Let's get to where things are not functioning properly, and that is the UK. How do you look at the UK disaster meltdown? I'm completely editorializing, but who wouldn't say that?
How do you really feel?
I mean, come on.
How do I feel? I'll start with what I said earlier, which is I think that so much of this is about credibility and clarity, and what we're dealing with is a lack of credibility and a lack of clarity in central bank policy, and you have to start there. They're dealing with a set of issues that's different than what we're dealing here, UK and Europe at large. Obviously, the inflation that we're seeing here is demand-driven. We've got more fundamental economic strength. There you've got some supply-driven inflation and an energy overhang. I think the UK is interesting because it does speak to the interconnectedness of these markets and the known unknowns, if you will, of how some of these markets could bleed into one another. But again, it's functioning. So they intervened. They finally gave clarity, said we need to fix this as quickly as possible. We have a lot of UK pension clients. They are taking that very seriously. I think they are selling assets appropriately, and that will then resolve itself. So as disorderly as that feels, that even happened in a pretty orderly fashion in terms of the market's ability to absorb it. If
tomorrow we don't get the BOE buying anything, and that deadline's real, what happens?
I think we go back to business as usual, and we wait to see another card.
Okay, so like it'll be bad, but we can still manage, is what your point is. So are you buying in the UK right now?
We are selectively buying in the UK. We're active. Obviously, I would expect, given the state of the pound, that you'll start to see funds flowing into that market on a relative basis. We're active in the private credit market. We're modestly active in the alternative credit space. And we've been active, as I said earlier, as a liquidity provider to some of these asset owners that are looking for liquidity.
Would property be interesting to you? I read an article this morning that things like 20% is what we could see in a fall of UK property values?
Yeah, we have a very large European real estate business, and obviously when you get this type of a re-rating, there's going to be opportunity to invest.
So let's get regional for a second. I know I have a question for the audience, which I will get to. But let's go to our next poll. So the poll we were looking at is, where do you think the biggest opportunity, what do you think provides the best opportunity? We're talking about the UK. Let's do Asia, Europe, US, and UK. We'll take a couple seconds for you guys to pull in on that and which one you guys like the best. But if the UK is investable for you, is Europe?
Europe's absolutely investable. As a private manager,
everything's investable at the right price.
Everything's investable at the right price. I think that's exactly right. So our job is to be in local markets, understanding assets and companies, and then putting money to work. What's challenging is those days are over for now because it's all macro. But at the end of the day, we are very, very micro, local investors looking at discrete assets, discrete companies, discrete cash flows. So most private investors have to be macro aware because it affects flows and values, but you have to be great at the micro. Because the macro, again, over a 5 to 10 year period, you're going to get your window because you're never a forced buyer and you're never a forced seller.
So to that point, on this what you guys said, so we're looking at, I honestly can't see, 40% for Asia, 9% for Europe, US 42%, and UK for 7%. So I'm wondering, if you see that, are you like, yes, UK and Europe invest right now, US and Asia, maybe valuations are too hot? Is that, how would you read that poll?
I always have a challenge with questions like this because what asset class, what market, what return expectation, what volatility. So if you said Asia, in Asia right now, we're active lending in the developed markets of Australia and New Zealand. We're active in the bond markets, taking advantage of a fair amount of distress there. We're fairly active in the infrastructure lending space, all with completely different risk-return profiles. So yes, there's plenty to do in Asia, but it really depends on where you are. Same with the US. So from my perspective, all of these are investable. If this is a reflection of where can you generate the highest risk return, that's probably maybe what this is reflecting.
So let's go to alternative asset investing. Yeah. What do you like? What's interesting?
Right now, for markets like this, when they're transitioning, we are doing our best to stay shorter duration, lower risk, floating rate. So of our $335 billion, over $200 billion of it is in private credit generally, which is performing very well, obviously, given the increase in base rates, and now spreads widening is presenting a pretty good opportunity. So we're able, in the private credit markets, to generate 10 to 12% type rates of return to take senior risk. That's a pretty comfortable place to be right now while we wait to see the markets transition. When you start reaching for that 15 to 20, price discovery becomes an issue, and you're having to take on a healthy amount of risk to capture that excess return. So my own personal view is we're trying to stay, less risky, a little bit more cautious, and capture all of the excess return we can right now without putting ourselves too far out on the risk spectrum.
So to that point, if we look at where the leverage is, and like the big ball of leverage that's been rolling around since the dot-com bubble, even before that, where is that right now? Some would say it's in the credit market, corporate credit, or alternative assets.
It's on central bank balance sheets. So
that's
where it is, and everybody is always trying to find where the canary in the coal mine is. That's where all the leverage went. And the interesting thing about these markets, the consumer is fundamentally deleveraged. The banks have deleveraged and simplified. The private credit markets have actually deleveraged. They've grown, but the attachment point in terms of where they are relative to the equity is lower than it's ever been. And they're supported by much larger, much more mature, much more evolved equity markets. So from a market setup stability standpoint, it doesn't feel like there's excess leverage. Again, I think we're all thinking back to the prior crisis and saying all crises involve some form of excess leverage or some part of the financial markets where there's bad behavior that we can't see. Based on what we see, we're not experiencing that right now.
So there's a question from the audience, which is a fun one. So if the recession and higher default rates don't come, and to be fair, I feel like I've been hearing about default rates since 2015, where will portfolio positioning be wrong-footed?
I think right now one of the challenges is the markets are not, because of the fundamental performance in certain markets, reflecting spreads commensurate with the amount of distress that people are expecting. So if you look at leveraged credit as an example, most of the attribution for the return we're getting now is just the increase in base rates with a modest amount of spread widening. There's probably more spread widening to happen, which makes it a more attractive opportunity, but then obviously will challenge the valuation of what you own. I think in the private equity and probably more so in the growth equity and venture markets, I'm not sure that those markets have readjusted yet to the new valuation environment. So I think those portfolios still have a way to go to reflect, the potential future economy here. But I think investing in credit through a cycle is a great place to be.
That was the next question. Do you think investing in credit is a good move in a time like this? I mean, he's going to say yes.
If not, I'm out of a job, so I have to believe it.
No, he's definitely retiring. But to that point, we were talking about alternative assets for a second, and I understand that you're on the cautious risk scale spectrum, if that's not a complete oxymoron. Is there a level, though, of rates or the Fed or neutral rate that freaks you guys out?
No. And again, we've been investing in these markets for 25, 30 years, and I just remind people, we've had 5% rates before. We've been through recessions. Investing with anxiety is not a successful investment formula, so I think we try to understand what's in front of us, invest based on what we know, and I do think that there's a lot that we see given the assets that we own around the globe, but the ability for us to pivot from liquid markets to illiquid markets or debt to equity or real assets to corporates gives us a fair amount of confidence to navigate these types of markets. So no, there's not a level at which we get anxious. It just means that the mix of our deployment is going to change.
Okay, fair point. So alternative assets, then, if people are like, oh, that's too illiquid, that's a problem, the way Mike looks at it is, sure, but then I have all these other things to make it okay.
I think liquidity, and this is, it's I don't know if this is the right way to express it, I think that people overvalue liquidity. And what has been happening over the last 20 years is people realize that when they get into difficult markets, all of the liquid assets that they own are fundamentally illiquid because they don't want to sell them at the price that the market is willing to bid them. And so...
So they're just mad that they're not getting what they want?
Well, then they're illiquid because you have all these people that are sitting on high-grade bond portfolios that are saying, I'm not going to sell this at this price. So by definition, if they're not illiquid, they're less liquid. And so most of the institutional and retail investors that we manage money for sequentially over years are reevaluating their actual need for liquidity and being more comfortable taking real illiquidity risk in their portfolio because they can still get some pretty significant excess return by taking on that illiquidity. And that's been happening sequentially with every crisis.
Is that a danger, though? Or what point does that become a danger?
I don't think so. I mean, it's interesting. I think one of the reasons why the market is functioning as well as it is now is as the private markets have grown and evolved, we're able to step in almost as a support mechanism for the liquid markets, right? So if you think about the leveraged loan and high yield markets sitting on the other side of the private credit market, 20 years ago, these markets would be showing significantly more volatility because you didn't have natural cash buyers on the other side of this distress. You had the banks that were in making markets with retail investors that was exhibiting a lot more volatility. Now you have some pretty large private managers that are actually able to step in and buy those assets and support prices in a way that they weren't before. So I actually think that private equity, private credit, they've all actually proved to be pretty significant stabilizers in these types of environments.
That makes perfect sense. And the other end of that, though, people would say, yes, but has that kind of capital and that kind of business model been tested in the same way in a massive crisis and a massive blow-up?
Well, COVID wasn't easy, and not only did it perform well, it performed exceedingly well. The GFC was not that straightforward, and we performed okay through that. .com, so each one is different, but I think we now have, 30 years of actuarial evidence that would tell us that the private markets are doing what investors expect them to do.
I'm going to sneak in one more question. What's the thing you're most excited about over the next year, investing-wise?
Oh, I thought I was about to say Yankees winning the World Series.
Or personally, it could go either way.
This is about as good of a time to be in our business. I don't mean everything's rosy and we're making money hand over fist. But it's finally interesting again. I mean, if you're a professional investor, for 15 years, everything was up and to the right, and everybody looked like they were, you know, great at what they did. We have a whole generation of investors that have never been through a cycle. So we're finally we're getting a good old-fashioned cycle with a lot of cross currents and a lot of information. Everything's exciting right now, to be honest with you. This is about as interesting of a time as we've seen.